There's no doubt about it. 2020 was the year that DeFi shined. Indeed, those projects that saw the largest gains in their token price operated in this smoking hot crypto niche. It's not just the token price gains that were off the charts, however. True value locked in DeFi has literally pulled a 20x from the start of the year. Truly mind-blowing. However, all of these headline numbers got me thinking. How in the hell do you actually value a DeFi protocol? And which tokens are incredibly undervalued? My name is Guy, and today I'm going to be exploring just that. I'll be going through some of the most important valuation metrics and indicators that you have to use when picking protocols. All that is to help you snag the opportunities and avoid the pitfalls in the DeFi land. Before I get going, I need to get some legal mumbo-jumbo out of the way. This crypto guy is no financial advisor. Sorry if I got your hopes up. That means that this video is for entertainment and educational purposes only. It's also no substitute for your own research. With those pleasantries out the way, I'd like to welcome anyone new to the Bureau. Good to have you here, and I'll do my best to blow you off your seat with my crypto knowledge bombs. I've dedicated the last 2 years of my life to creating the best crypto content I can. If you want to be part of Club Coin Bureau, then get that exclusive membership pass by smashing that subscribe button and dinging that little bell. That way, you'll never miss out on any of my market updates or project reviews. If you're a bit of a Coin Bureau veteran, then you might have noticed that I've mixed it up today with a different t-shirt. If you like it, then watch till the end of this video where I'll tell you where to get one. Strapped for time? That's okay. I've popped some useful timestamps below so you can skip ahead to the sections that you'll get the most value from. Okay, got your abacus ready? Great, this class is about to begin. So, here's the big question. How do you value a DeFi protocol? Well, you might think that it's as simple as bumbling onto Coinmarketcap and looking up the market cap of that DeFi protocol's token. Well, market cap is perhaps one of the most flawed valuation metrics. Let's take a look at an example. I'm sure that many of you know about Uniswap's Uni airdrop. This was when the DYDX distributed millions of their governance tokens to the ecosystem. Now, at the time of this video, the Uni market cap stands at about $717 million. However, before that Uni token release, did Uniswap have zero value? I think not. So that's why market cap alone is a pretty poor metric to value these DeFi protocols with. Even today, there are well-known DeFi protocols like DYDX that simply don't have a token and are merely listed on crypto price aggregators as an exchange. So it's not as if Uniswap was a one-off example here. So how else are DeFi protocols valued? Well, a common metric that's often bandied about is total value locked, or TVL for short. That's just a geeky way of expressing the total balance of ETH and ERC20 tokens in the smart contracts of a specific DeFi protocol and expressing that value in US dollars. In other words, this TVL figure is essentially the balance sheet for any given DeFi protocol. Yes, that figure does matter to a certain degree, as an unused protocol with a TVL of 0 is probably not going to be worth much, no matter how you slice or dice it. Now here's the deal. Most people probably overvalue TVL as a DeFi metric because that's the stat most commonly used to rank DeFi projects. The problem is that it gives people like me and you the impression that this value is, well, locked. That's far from the truth. Let's take Uniswap as an example again. Back in September of this year, a Uniswap fork called SushiSwap migrated over $830 million of crypto assets to its own version of the protocol. At the time, that represented 55% of the assets staked on Uniswap. In other words, the TVL of Uniswap dropped by more than half in a single day. Hardly locked value if you ask me. Indeed, this liquidity swayed back to Uniswap from SushiSwap when Uni tokens were introduced. And, crazy as it may be, back to SushiSwap when Uni liquidity incentives ended recently. What this example shows is that TVL can be cannibalized by protocol forks very quickly indeed, and is by no means a static measure of value. So yes, hardly a killer valuation metric. All that is probably not surprising to those that truly understand what DeFi protocols are. In short, they merely provide the rule, logic, and incentives to encourage economic activity. Most of the time, that's done by crowdsourcing crypto assets from people like us and using them to do things like crypto lending, think of Aave, market making, think of Uniswap, or to create synthetic assets like synthetics. So, why the heck would anyone want to supply their crypto assets to these protocols? Well, it's because we are all incentivized to do so with things like interest or the ability to earn a percentage of the fees generated by the protocol. All that's happening with DeFi protocols is that users are putting up their crypto in return for these value flows. What all that means is that value creation in DeFi is contingent on how well a DeFi protocol monetizes that balance sheet or TVL. I know that sounds like wizardry, but it really isn't. Balance sheet monetization is exactly what banks do with your bank deposits. That cash doesn't just sit there in a version of Gringotts. Instead, the bank monetizes that balance sheet through loans, investments, or using it to provide other financial services. In essence, DeFi protocols fundamentally work in a similar way, except those pesky banker middlemen are replaced with smart contracts on public blockchains. So, that brings me onto a very serious topic. How the heck is value created and captured by DeFi protocols? To understand DeFi protocol value creation, we have to define who the main stakeholders in these protocols are. The way I see it, there are 4 major categories of people here. People that supply liquidity to build up that protocol balance sheet in the first place. Users, the developers who have built, maintain, and add features to the protocol. And finally, you have token holders, at least for those projects that have a token anyhow. These chaps tend to govern DeFi protocols and take a cut of any fees generated. Liquidity providers get value through economic incentives and the value proposition offered by a specific DeFi protocol. This includes not only trading fees and interest rates, but also token incentives, which consequently makes them a token holder as well. So, DeFi protocols can create tremendous amounts of value by offering unique or superior value propositions to liquidity providers. They also offer users access to the services they want, which then attracts more token holders who want the governance right to that protocol and a cut of those fees. Now, that makes for a pretty serious value creation loop. However, here's the deal. Value creation is one thing, but value capture is another thing entirely. I hate to break the news, but sustained value capture is actually super difficult for DeFi protocols to achieve. The reason why is that this value proposition needs to remain attractive compared to competitors. Otherwise, it's highly likely that there will be capital flight. I mean, you might be getting some decent economic incentives for lending out your crypto on a certain DeFi protocol. However, there is nothing stopping another project from offering a slightly tweaked economic model that provides better incentives. But that's not the only thing that DeFi protocols need to do to retain or grow the amount of liquidity supplied to them. Security is a big deal too. I mean, come on folks, how many of you would be happy to supply your hard-earned crypto to a DeFi protocol that has been shown to have buggy smart contracts or to have fallen foul to exploits? Take Value DeFi as an example. This decentralized finance yield aggregating protocol was exploited to the tune of $7.5 million in DAI recently. What's maybe even more embarrassing is that the Value DeFi team had recently declared that it had flash loan attack prevention. When all was said and done here, that attack ended up resulting in a $6 million net loss. Now, I don't know about you, but I can't imagine that after all this, people are queuing up around the block to supply liquidity to Value DeFi anymore. What all that means is that the TVL for a DeFi protocol can go up in a puff of smoke if things go wrong. A bit like how a fund manager who makes a catastrophic decision can expect massive capital flight from their fund. Protocol users essentially want the financial services they are using to work. Shake that confidence and those users are likely to jump ship to a competitor real fast. When it comes down to token holders, it's essentially very straightforward. If the token price outperforms the wider crypto market and other DeFi competitors, then these stakeholders are likely going to be happy. Finally, you have developers who get value through their protocol succeeding. That's normally done through their token holdings and salary. What you should be able to see is that fundamentally, it's hard to value DeFi protocols. Similarly, it's hard for them to value capture because there are so few economic moats. Also, if there is a single security compromise, that could literally shatter the confidence of stakeholders and spell the end of that DeFi protocol. Now, I've thrown around the term economic moat as if it was nothing. How rude of me. Let's take a look at why these matter when it comes to the value capture of DeFi protocols and why it could be a problem for their valuation. The term economic moat was popularized by Warren Buffett. Yes, the same legendary investor that called Bitcoin rat poison. In short, an economic moat is simply a distinct advantage that a company has over its competitors. This allows a business to protect or increase market share and profitability. In other words, pulling up the drawbridge on its competition and making its dominance almost unassailable. Needless to say, these businesses tend to create and capture tremendous amounts of value, which in turn leads to sky-high valuations. I'm looking at you, Apple, Google, and Facebook. Now, the problem for DeFi projects is that building these economic moats is damn tricky. After all, someone can withdraw their crypto from a DeFi protocol whenever they want. What that means is that capital can quickly flow from one protocol to another. Also, the cryptoverse's propensity for open source development means that traditional competitive advantages like economies of scale, patents, and regulatory licenses are simply not there in the DeFi ecosystem. But wait, you may say, what about liquidity? The likes of Binance are top centralized exchanges in part due to their oceans of liquidity across numerous trading pairs. Yes, that might be true in the centralized world. However, in DeFi, liquidity cannot exactly be defended well. As mentioned earlier in my Uniswap SushiSwap example, other protocols can vampire mine that liquidity. Another case of this vampire mining can be seen in Swerve Finance's successful cannibalization of 40% of Curve's deposits in just 4 days. Yep, again, that was another case of a DeFi project fork attracting a ton of the TVL from the original. So, why is it that every time I talk about liquidity cannibalization, it involves a fork? Well, that would be down to the open source nature of DeFi, which means that pretty much anyone can copy and paste that code and open up their own copycat DeFi platform. On top of all that, you have the problem of one single security breach or smart contract problem, leading to the potential for loss of confidence in the protocol and a plummeting of its token price. Take Harvest Finance, for example. In October, the protocol was hacked for $24 million worth of stablecoins, and that led to the farm token dropping 60% in a single day. A pretty horrendous day at the office, if you ask me. So if there's one thing you should take away from this video, is that it's bloody difficult to build economic moats in DeFi. However, it's not impossible. Let's take a look at some economic moats for DeFi protocols to help you pick those value-capturing winners. Time for a quick shout-out to the sponsors of this video, Bittrex Global. Now, I know many of you are watching this vid because you're interested in DeFi. But here's the deal. When DeFi gets smoking hot, those gas fees on DEXs can be insane. That's why I thought I needed to tell you folks about Bittrex Global's DeFi promo. Basically, until the end of the year, you can trade any DeFi tokens on the exchange without paying any gas or trading fees at all. If that sounds good to you, then be sure to head over to Bittrex Global and create an account to take full advantage of that. Be sure to use the link I've provided in the description below. One final thing, I'm afraid that US viewers sadly can't get involved here. Sorry about that one, folks. Now, back to the magic. The first type of moat in DeFi would be integrations. I mean, it takes a certain degree of skill to integrate external services like, say, Chainlink pricing oracles. By doing that, you're allowing your DeFi protocol to take advantage of secure and reliable off-chain data. So, these types of integrations could be seen as a type of moat. After all, they do have a replication cost. Next, you have the protocol's community. Now, this may sound woolly, but if history has taught us anything, it's that well-supported crypto projects tend to have a better chance of success than those with small support bases. A strong community usually means an army of people shouting about a protocol, and that in turn attracts new supporters. In a way, it's a bit like network marketing. Sometimes protocols attract high-value ambassadors. That might be a crypto YouTuber with a big following who constantly bangs on about how great the project is to their audience. A moat that few people talk about is an easy-to-use interface and user experience. After all, actually using DeFi protocols can be frustratingly difficult, and the truth is that many people simply give up using them altogether. So, if you have an easy-to-use front-end like Wi-Fi that's easy to navigate and a situation where all its competitors have fiddly interfaces, which one do you think people are going to choose? I mean, it's a bit like how Apple has been so successful over the years. They have rarely had the best hardware and generally command a price premium. But those Apple products sell like hotcakes due to those easy-to-use interfaces and smooth user experiences. Now, of course, the UI can also be forked. But if a project is able to be the first to design a new user experience, it could allow it to build some network effects as people migrate to it. Moreover, those DeFi projects that tend to do really well are those that are constantly tweaking and improving the user experience. So that's UX, an important factor to gain users. Another economic moat has got to be reputation and security. This is of primary importance when it comes to DeFi, as we are talking about people's money after all. I doubt any of you would be happy chucking a decent chunk of value into a smart contract you weren't confident in. So, when there are issues like the SushiSwap exit scam or the fact that Harvest Finance is built by anonymous developers, it is simply harder for that DeFi protocol to capture value. That's why I personally look to see if a DeFi project has had a security audit and look into the project's reputation when I do my own research. The resources at the disposal of a DeFi protocol team is another factor I like to pay close attention to. These funds may have been raised through crowdfunding, institutional investors, or even profits from the protocol's operation. However, the point is that protocols with a war chest have a competitive advantage over those that don't. Those resources can be used not only on R&D and community development, but they can also be used to pay for all those extensive security audits. So, essentially, these DeFi projects can use one moat to further strengthen their other competitive moats. My final economic moat to look out for has got to be the team behind the DeFi protocol. Being nimble and constantly innovating is bloody valuable. Teams that do this are always ahead of the curve, and everyone else is playing catch-up. A good example of innovation serving as an effective business moat would be Yearn Finance. The project offers a plethora of services ranging from token swaps, automated investment management, to credit lending. This is all thanks to a developer called Andre Cronje, who is quite a legendary figure in the DeFi space. If you want to learn more about Yearn Finance and why I hold some of it in my portfolio, be sure to check out my video on it right over here. So, maybe when you're evaluating DeFi protocols, you should ask yourself, has anyone else built this service before? If not, then chances are that you're looking at a DeFi protocol with an innovative team rather than one that just forks someone else's work. And if someone did just fork code and launch a new protocol, you can't be guaranteed of the same level of ongoing innovation being implemented on the original protocol. Code is one thing, experienced developers are another. Now, I know that a lot of these economic moats are pretty intangible, but that's the point. The truth is that DeFi protocols are incredibly difficult to value right now, seeing that all of them are in their primitive states. Sure, these protocols will constantly evolve and become more refined over time. However, we're just scratching the surface with DeFi, and frankly, no one is quite sure how this space will evolve in the future. That's why you should be incredibly cautious when you hear about some hot new DeFi project on YouTube and paying sky-high valuations for DeFi tokens. But that all begs the question, what could the future hold for DeFi balance sheet monetization? Well, I'm personally a big believer in the idea that he who monetizes their balance sheet best will ultimately capture the most value. So how might DeFi protocols do that in the future? One thing that isn't happening in DeFi yet is a differentiation between long-term and short-term liquidity providers. The fact that liquidity providers can literally jump from one protocol to another in the blink of an eye is one of the problems preventing true value capture. We essentially have a situation where long-term liquidity providers are not rewarded for adding more value to a protocol, and short-termism isn't punished. So, one of the things I'm on the lookout for are protocols that implement features that enhance value flows for locking up capital for longer timeframes. Indeed, any protocol implementing such a feature would have real TVL, true value locked. Capital that's locked up for a certain period of time can then be used in order to generate above normal returns in other yield-generating assets in the crypto space. Yields that are more favorable than those that you can get with short-term lending. Hence, by sacrificing short-term liquidity, providers get higher interest and DeFi protocols get more sticky liquidity. This process of locking up longer-term deposits to be used to generate additional yield is actually pretty common in traditional finance. It's called rehypothecation, and this is what allows those banks to offer higher interest to longer-term depositors. Currently, I don't know of any decentralized DeFi protocols that operate on a rehypothecation model. There are, however, centralized crypto lending solutions that operate on this long-term deposit model. One of these is Celsius, which is perhaps the most well-known centralized platform on the market. If you want to learn more about that, then be sure to watch the video right here. Of course, it's centralized and the antithesis of DeFi, so it will be interesting to see if there are any decentralized solutions that can implement a similar model. And if they do, how can they convince users to lock up their funds in a smart contract for a certain period of time? This would therefore make it inaccessible until said time elapses. As we all know, yield farmers move oceans of capital quicker than you can say Satoshi. So, it's an open question as to whether they would be comfortable with this. Perhaps a question to be answered another day. And that's about all I have time for today, folks. I'm sure there are many so-called influencers out there that tell you there's a magic formula for valuing these DeFi protocols, or make out that they know what a project's price potential is. The truth is that DeFi is still in so early a stage that it's impossible to know. However, I thought it would be valuable to share my insights on what I personally look out for when weighing up these projects to give you an insight into my thought processes. Now, before I leave you folks, I do need to let you know how you can get your hands on this Pimping Crypto King t-shirt right here. I'm selling these threads in my new merch store, which you can find in the description below. Any sales help support the channel, so thanks in advance to anyone who wants to help a brother out. Finally, if you learned a thing or two, then be sure to moon up those likes. Also, subscribe or I'll hack your Bitcoin wallet. Guy signing off. I hope you enjoyed watching that video as much as I enjoyed making it. But, truth be told, I just couldn't fit everything in that I wanted to. So much more that I have to say. Now, this is exactly why I started my weekly newsletter. It's a succinct summary of all the important news, reviews, and analysis I have for the week ahead. I also disclose my personal portfolio as well as other juicy coin tips. Keen? Well, don't delay. Head on over to the description below. There you'll find a link to a sign-up form. Then just insert your email and hit submit. Final step is just to confirm your email, and that's it. You're all set. Oh, and I hate spam more than anyone, so you sure won't be getting any from me. Hope you folks enjoy the next email.